fresh off that memo everyone's talking about.
Thank you, Sarah. It's nice to be here.
It's good to have you, and happy holidays. So let's start with the sea change. That was the big headline from your report. It's how you kicked off your memo. You said 53 years in your investing career, there have been 3 sea changes, and we are in one of them. What does that mean?
Well, a sea change is a major transformation of the environment, a complete change in attitudes, et cetera. And I suspect that we may be at the beginning of one. The first one was the fall of interest rates from 20 to 0 between 1980 and 2020, which had very, very positive effects. The second was the opening of investors' minds to what we call risk-return analysis. And before the 70s, the job of the investor was to avoid risk. After the 70s, it was to intelligently take risk, and that was a big change. And I think that we may be on the doorstep of the third.
So what is this sea change?
Well, since the Fed, central banks around the world, and the Treasury took strong action to solve the global financial crisis in 08, 09, we have been living in a highly stimulated, very positive, easy money environment for roughly 14 years. I think that, a lot of people began to invest or came into the business in those 14 years. Not too many have a perspective on the period before the global financial crisis. And they may think that the last 14 years was normalcy. I don't think so. I think it was the best imaginable period for borrowers and for asset owners. And I don't think that it's necessarily going to continue.
So do you characterize the past 14 years post-financial crisis as a bubble? And now that's popping, we return to some sort of normality or even a crash?
Well, a bubble, most people take a bubble to mean irrational appreciation. And the asset appreciation in that period was not terribly positive. It wasn't an unusual 14-year period in terms of asset returns, et cetera. And it wasn't the result of unrealistically optimistic thinking. So bubble, I think, has a specific use. But it was a hyped, unusually positive period of when everything was easy for certain classes of people, as I said before, borrowers and asset owners in particular. And it isn't normalcy, and it's not, I don't think, going to be the norm going forward.
So is your bottom line that stimulative rates are a thing of the past, and now we should just get used to higher rates for longer, even though the market is sort of thinking that they might go down next year?
Well, I don't think that we should expect, I don't think it's prudent to expect to have stimulative rates all the time. I describe that as taking a shot of adrenaline every morning. I don't think it's very viable. We'll see lower rates. Well, first of all, when the battle against inflation is won, I think rates will, the Fed will bring the Fed funds rate back down, and we'll see very low rates again if there's a recession that has to be cured over time. But I just think that, people got so used to zero rates of interest. The Fed brought the Fed funds rate to zero late 08 to fight the global financial crisis and left it there for 7 years, and had a dickens of a time raising it because it thought it thought that we shouldn't permanently be at zero, but the markets had tantrums and resisted. I don't think that what I say in the memo. I don't make many predictions. I don't believe in predictions, including my own. We don't bet on predictions at Oaktree. But what I said in the memo is I think that for the next several years, the Fed funds rate is more likely to average between 2 and 4 than between 0 and 2. That's as far as I can go.